Hi there, everyone. I'm starting this video off with a question. What do you think of business? You know, we're in the business school. You're each studying some facet of business. In the world we live in, business can be something of a dirty word. We use phrases like, let's get down to business, or it's not personal, it's business. That one's my favorite when it's something that's unethical, right? It's not personal, it's business. Or it's a dirty business, or all up in my business, or do your business. Business seems like one step away from just busyness for its own sake. Politicians talk a lot about business. That seems to make it less likable. Remember these guys? Not too high on the likability scale. And there's some pretty famous business villains, especially in Hollywood, right? So you remember Gordon Gekko, who famously said that greed is good? Or how about more recently, Leonardo DiCaprio as Jordan Belfort in The Wolf of Wall Street? Or perhaps my favorite villain, who is a straightforward personification, Lord Business from the Lego Movie. What's the message here? Business has an image of being unethical and uncaring and evil, of being an entity en masse with no conscience. Well, what do you think? Do you think that's true? You know, this isn't a new sentiment. Back in the 1800s, Henry David Thoreau said, "It's truly enough said that a corporation has no conscience, but a corporation of conscientious men is a corporation with a conscience." As we launch into a discussion of what it takes to bring a company into existence, and then to give it power by finding a way to finance it, it's important to keep in mind that these efforts have an impact on the world. Now, do I believe that business is bad? No way. I'm not naive that business can be bad, but I believe businesses and startups in particular can be an incredible force for good in the world. I believe business amplifies the intentions of those who work in them, and I think that means that they can be transformative. I believe that business can solve so many problems and ultimately change the world for the better, like this simple solution to the difficult and often dangerous problem of transporting water in Africa. Or how about this soccer ball that generates power from being kicked around during the day so children can have light at night to read? For every one of these videos, I'll try and give us an agenda. This is the agenda for this one. We're going to talk about what is technology, how we actually got to equity financing, what's the difference between private versus public equity investing, and the quintessential notion of the opportunity. So to start off, how many of you are interested in technology and tech companies? I know I am. As a matter of fact, what is technology? We sometimes get confused and think that technology is limited to just circuits or lines of code, like electronics is the only place where tech lives. But the heart of technology is simple. Technology requires two things. It requires an idea and that idea get executed. These two are like the sperm and the egg. The concept, or maybe conception, of a company, just like human conception emits a spark of zinc as the sperm meets the egg, a great business is conceived in a spark of inspiration, a solution to a problem, a better way of doing things. Now, I know that we're just getting to know each other, but I can already tell that each of you have the spirit of an entrepreneur. I know that you are winners, that success is inside of you. How do I know that? Because each of you started life by beating out over 3 million competitors. So ideas and execution, technology. PayPal founder and prominent VC Peter Thiel said in his book 0 to 1, humans are distinguished from other species by our ability to work miracles. We call these miracles technology. Properly understood, any new and better way of doing things is technology. So what other technologies are there besides just electronics? Well, what about military technologies? What about metallurgy or agriculture, animal husbandry, politics, or economics? By Peter Thiel's definition, every company would be a tech company. If it isn't different, better, or special, then why is it even there? What benefit does it provide, and what problem does it solve? So tech isn't really new. This idea of working miracles by solving problems isn't new. Let's look back at some historical examples. Here's a super old piece of tech. This is thought to have been developed 26,000 years before another old piece of technology, the wheel. It's called an atlatl, and it's a spear thrower. Effectively, it's a stick with a notch in the end that lengthens the arm of the thrower. So the physics make spear throwing more powerful and accurate. Here's a shot of it from a Mayan petroglyph or hieroglyph. Here's another military technology. It's a battle formation called the phalanx. The phalanx required that each man in the phalanx covered the next with his shield. Linked together like one giant sword, they would cut a swath through the unorganized hordes of charging mobs and whatever else. Now, this picture is from a movie dramatizing the stand of the Spartan Greeks at Thermopylae, where they protected the birthplace of democracy, the famous 300 that stood against the onslaught of the Persians. The phalanx was strong for a long time. Then came the formation of the Roman legion. You might have seen this in some old movies too, this checkerboard pattern that allows the soldiers to effectively break up a phalanx and attack it in smaller chunks. Or how about this? Here's a painting of the Mongols. The Mongols controlled the largest empire by land of any empire ever to exist on Earth. No small feat. And what were their military achievements? Well, silk under armor was one, so they could remove arrows without shredding the flesh. But their big achievement? A little thing called stirrups. Stirrups allowed the Mongols to guide their horses with their knees and use both hands to shoot bows and arrows. Just like military technologies, we've had advances in financial technologies too. This is Jean-Baptiste Colbert and Adam Smith. Smith would ultimately write a treatise on free markets and wealth creation that would get him dubbed the father of economics. Colbert was the father of the earlier system, which was called mercantilism. One of the tenets of mercantilism was that there was a finite amount of wealth in the world, which of course meant that if you wanted to get more than you already had, your only option was to go take it from somebody else. Now, this is the idea that spawned the entire age of European colonialism. European kingdoms had been fighting each other for centuries, and by this point, they'd all become pretty tough. So they decided that to acquire more wealth, they needed to find easier prey, like maybe the Aboriginal natives in less developed areas of the world, in Africa, in the New World. Adam Smith, on the other hand, showed that wealth could be created. So there wasn't a finite amount in the world. It could be created by increasing the number of transactions within an economy. So he published a book called An Inquiry into the Nature and Causes of the Wealth of Nations, which was published in 1776. Now, it just turns out that something else happened to be going on that same year. Some upstarts in America decided that they would try their hand at a country whose economic system is based in the principles of free market economics. And, as you know, we declared independence. That covers what technology is. Now let's look at how equity financing evolved. Back up just a few years before, and we'll talk about another financial technology that was developed by the Dutch East India Company, 1602. Okay? So back up from 1776 to 1602, and the Dutch East India Company is trading between Europe and markets in Asia. They need some cash in order to make sure that their ships traveling back and forth to Asia are carrying full loads. Now, it's expensive to finance the entire cargo of a ship, so they needed a lot of money, but most of the people individually could only come up with a little bit of money. A person's private wealth wasn't enough to finance a whole ship. So what they did was they offered private citizens the ability to purchase small portions or shares of the cargo. In return, they would receive an equivalent proportion of the profit or return when the ship returned. This was effectively the world's first IPO. And it wasn't without risk, right? Ships could sink. Let's take a look at exactly how this spun into the history of public financing. So, 1602, Dutch East India Company does its first IPO, issues stocks to the public. War of Independence. The U.S. was really forward-thinking financially at this time, and they actually used war bonds to finance the War of Independence. Now, you can imagine, like the U.S. was by no means guaranteed to win this war, so it took a lot of faith for somebody to invest that the U.S. would actually succeed and be able to pay them back. But they used this tool and used it to finance the war. In 1792, 24 large merchants create the New York Stock Exchange by agreeing to meet every day and trade stocks and bonds on Wall Street in New York City. By the mid-1800s, the potential for raising capital in the stock market had become super well known. Lots of companies were selling stock to raise expansion capital, and by 1900, you're into millions of dollars worth of stock that are being traded. This is millions of dollars at 1900 valuations. All of this is happening still out on the street corners on Wall Street until, 1921, the stock market officially moves indoors. And then only 8 years later, on October 24th in 1929, the market crashes, and it crashes hard. This is the crisis that starts the chain reaction that will create the Great Depression. Now, as a result, in 1932, FDR gets elected. He'd run on a platform of economic fixes for the Depression. The economy is in shambles, and he's like, we will fix this. He begins by enacting the regulations of the New Deal, including the passage of the Securities Act of 1933. This is followed swiftly the next year by the Securities and Exchange Act of 1934, which creates the Securities and Exchange Commission. And the SEC is still the active regulating body for the sale of securities today. Ultimately, the point is that publicly trading a company's equity is the most advanced technology that we've developed so far in the world for financing companies. Publicly traded financing is the best that human beings have come up with for how to finance companies, increase the wealth of these countries by increasing the transactions, by growing the companies. As a result, stock exchanges are all over the world. These are the top 16 exchanges. All of these have a market cap of over $1 trillion. Over 93% of the stock value in the world is in 3 continents: North America, Europe, and Asia. 87% of the value of the value in the entire world is in the top 16 exchanges. And the New York Stock Exchange is bigger than the 50 smallest exchanges combined. That gets us through the history of what is technology and the history of how we got to equity financing. Now we've got some more questions. So if going public is so great, if that really is the ultimate tech for raising money for a company, how come startups don't just go public right from the get-go? Well, for starters, it's hard. It's expensive. It's really close to impossible for a brand new company. If you're super sophisticated, you can do this. You can set up things exactly right, maybe use a vehicle like a reverse merger into a public shell. But for all intents and purposes, this is out of reach, especially for first-time founders. So what options do we have? Well, we can try funding it ourselves. There are some options that don't require us to get outside help, like independent wealth is always great. If you're just born with it, that's awesome. But what if you aren't? Well, we could use our credit cards. We could use sweat equity. I mean, it's really likely that no matter what you do, if you're in a startup, you're going to be doing some sweat equity. You could get a personal loan. You could maybe borrow against your home or your car. You could apply for grants depending on the type of business you have. You might be able to get people to gift you the money. Early crowdfunding was really just about getting fans to give you gifts for the promise that they might get your album or your Pebble watch or your backpack or some product in the future. Ultimately, though, most of the Kickstarter or Indiegogo campaigns kind of end up like GoFundMe campaigns. It's the what can you do for me model instead of what can I do for you, and that model just isn't very reliable. Oh, you could win some. You could enter a business model competition and win it. There's always profits. Profits are by far the cheapest and best money you can ever raise. But sometimes it can be really difficult to do hyper growth on just your own profits. I mean, even a very profitable company, if it doesn't manage its cash cycle right? If it gets in a scenario where the cash cycle demands more cash faster than it can collect it from customers, a profitable company can also go broke. So, I mean, don't get me wrong, profits are awesome, but they also might not be an option up front. So if we don't have the money, we can't win it or find it in enough quantity to achieve our goals, we'll have to raise it. Wait, raise the money? How do we do that? Well, the thing is, we're going to have to give something up, and the thing we're going to have to give up is the future. Well, awesome, right? That seems intangible. Here's what I mean by giving up the future. You've heard the expression, time is money. Well, the reverse is also true. Money is time. We're going to have to review some options to trade on the time value of money. Now we're talking, let's review the options for trading future income for cash in hand today. Some of our future options are debt. We could get a loan. With a loan, we give up future cash flows to pay interest, and we also risk any assets that we may have pledged as collateral. I mean, this could be tough if we're really early stage. What about equity? We could sell some of our stock. Now, we've already identified that selling in the public markets is probably not going to work for us. So that leaves those who buy stock in private companies. In other words, the private equity market. Private equity is broken down into the following groups. There is traditional private equity, which is typically looking to buy a controlling interest in a company in order to do a leveraged buyout of distressed or undervalued mature companies. So that might not be us if we're just a startup. There's venture capital. Venture capital is really a subset or a slice of private equity that focuses on riskier new ventures from seed stage through growth equity with an eye to a future exit at a higher valuation. We'll talk a little bit more on that later. We could look at angel investors. These are typically high net worth individuals who are accredited according to the definition of the SEC. They're making seed and venture investments themselves. Sometimes they're making these investments directly, or sometimes they're using angel networks like we've got a bunch of them here in Utah. Park City Angels, or even AngelList is nationwide. Naval Ravikant does AngelList. And sometimes they're done through middlemen or brokers. And then crowdfunding. We could look for crowdfunding is allowed now for equity. That rule was written near the end of 2015. So we're about a couple years into crowdfunding for equity. But this course is going to focus on scenarios where an entrepreneur is selling equity to either angels or VCs. So here we are. Our ability to grow a business, realize our dreams, change the world depends on our being able to fund the business, which means we need to sell some shares. So if we're selling equity to this type of investor, that raises the questions of, well, how much? How much equity should we sell? What's the right price for it? Where do we find the buyers? What do those buyers care about? What are they looking for? What makes the transaction good for both of us? Ultimately, the answers to these questions extend beyond the scope of what we can cover in only 5 weeks. Encourage you to take the advanced class, which is Finance 6310, for a deeper dive into some of these questions. But we will address some of the key issues and dynamics at work. We'll come at this problem from 4 directions. I talked about this in the intro video. The company, the context, the investor, and the deal. With this in mind, let's open up our first can of worms and talk valuation. Valuation is at the heart of almost every question you need to know about a company or about this type of financing. So how can you decide how much stock to sell if you don't know what it's worth? How can you tell if the money that you raise is enough to get you to your next milestone if you don't know the basis for how much money an investor will put in? At the highest level, any asset is valued in one of 3 approaches. There's the income approach, the asset approach, and the market approach. All 3 of these are attempts to answer the same question. What is the thing worth? And all 3 make the same assumption. It's worth what someone is willing to pay. They just approach that from 3 different directions. So real quick, the income approach is based on the net present value of a stream of cash flows. The asset approach is based on your book value, right? Assets minus liabilities. And finally, the market approach says, what has somebody recently paid for a similar thing? If your startup is pre-revenue, income is going to be tough, right? Now that said, SaaS companies are really trying to add recurring revenue to the tech startup model, which strengthens their appeal and kind of drifts them toward the income approach to valuation. They're not all the way there yet, but they're adopting principles of recurring cash flows as the key to their valuation. The asset approach is likewise going to be bad for startups because you don't have any assets. So as a result, almost all valuation methods for startups are some form of the market approach. In other words, we're going to use some comparables from the market in order to figure out what this company ought to be worth. We know that we're focused on a private sale of equity, not a public one. But would it make any difference? If we sold, say, 100 shares of stock on the public market versus 100 shares privately, which do you think would bring a higher price? In other words, are private companies or public companies worth more? Which one? Let's run a quick scenario to compare. So think about this. Here's a company that's generating $50,000 a year in sales, $10,000 a year in profit. Real quick, when we talk about sales or revenue, those terms are interchangeable. Likewise, if we use the term profits or earnings, those both mean the same thing. So here we've got $50K in revenue and $10K in earnings. As an investor, you do not have to manage this company. It has a qualified management team in place. You don't have to run it. Your shares are privately held. There's no market for you to sell them. You're locked in until the company either sells to another company or does an IPO. If you find yourself in a situation where you need cash, the money you invest here is not going to be liquid for you. You're going to be locked into the investment. No easy way to get liquid. Now let's look at company B. Almost the same, doing the same amount of business, has $50,000 in sales, $10,000 in profit, just like company A. It also has a qualified management team. You don't have to run the company. The only difference is that it's public. You can sell your stock whenever you want. So which company would you pay more for? Well, the answer is company B, of course. And why? The answer is that so here's these companies. They're otherwise identical, but one offers liquidity. And the truth is investors are willing to pay a premium for liquidity. The flexibility of liquidity is actually worth quite a bit. The greater the liquidity, the lower the risk. That's why when you put your money into a savings account, it generates almost no return. But because a savings account has to provide zero risk and 100% liquidity, it does that and provides very little in terms of return. So less liquidity, typically greater return or greater potential for return. So private companies are earlier stage, riskier, and have less liquidity. So we've covered private versus public now, history of equity financing, and you understand what technology is. Moving on to the next stage. If private companies are earlier stage, riskier, have less liquidity, why on earth would an investor ever take the risk? Well, let me tell you a secret. I could probably get you all to write a check right now today. Here's the business. It's the only startup in the world that has the recipe for a new gene therapy that attacks aging. It's guaranteed to extend human life by 40 years. And we expect that pretty soon it will be as mandatory for people as fluoridated drinking water. It is going to go everywhere. Everybody's going to pay for it. You have an opportunity to be part of this huge success. Earn millions, benefit the world, and get in early. You win? I use this to illustrate that investors invest because of the opportunity. Your first hurdle in getting investment is articulating an irresistible opportunity. Your second hurdle is to give your investors a reason to believe. This is a reason to believe that you can take this opportunity and make it reality. Most of what we talk about in this class is going to be about how to signal to investors that they can believe in your ability to do this, that you have the ability to execute. But none of that actually matters if you don't first show the opportunity. Your business model canvas assignment is actually all about understanding which opportunities look interesting and which business model components contribute to an investor's well-founded reason to believe that you can pull it off. Here's Paul Graham. He's the founder of Y Combinator, the most well-known startup accelerator in the world, and he describes the formula for capturing investment as this. Make something worth investing in. Understand why it's worth investing in, and then explain that clearly to investors. In other words, show the opportunity and give them reason to believe. In fact, this is Y Combinator's call for startups for 2017. These are the industries and categories that these guys believe will represent the best opportunities right now. Convince somebody that you have a company in one of these categories that is really going places, and you'll have a super easier time securing investment. Another simple but important thing to remember is that the people you're trying to get money from are investors. Philanthropists are donors. They expect nothing in return. Maybe their name on the building and to be remembered for their contribution. Investors, on the other hand, expect a return. And they all invest because they believe this one thing, that the value of their investment will go up. Sometimes founders miss this and think that their job is in fact to woo investors, make them fall in love with their product. That's just flat out wrong. Investors may care about the product, but if they can't see any way to make money, they won't give you any. This class and the advanced class are structured to help you think like a venture capitalist. I want you to understand the world from the investor's perspective. So when you go out, no matter what role you have, right? Entrepreneur, employee, or investment banker or analyst, you're going to understand both sides of the business. You're going to understand the founder and the investor. So putting our venture capitalist hats on, what's the venture capital model for seeing a return? Thinking like a venture capitalist means you're looking to buy companies at risk-adjusted private valuations, then sell companies after their IPO at public valuations. It's a buy low, sell high game. This also allows the investor to influence the success of the company. Most investors in venture capital don't take the company over, but they often take a seat on the board and help founders make connections to talent, to network, and ultimately to a future round of funding. That's it for this lecture. I hope you enjoyed it. We'll catch you on the next one.